Hey everyone, welcome back to Corporate Decoder, the place where we break down the companies that make the world tick. And boy do we have a juicy one today. VIAVI Solutions Incorporated filed their proxy statement, and it is packed with insights you will not want to miss. VIAVI, a company known for its testing and measurement solutions, is giving us a peek behind the curtain of their fiscal year 2025. This is tea just about numbers, it is about strategy, growth, and how they plan to keep their edge in a super competitive tech world. Stick around, we're going to decode what it all means for you. And hey, before we dive in, if you are all about getting clear, no nonsense insights from these corporate disclosures, hit that subscribe button. Also, we've got a fantastic community in our Discord server where we dissect these filings further. The link is in the description below, so join us after this. Let's get right to the heart of it. The financials. VIAVI is reporting an 8.4% year. Over-year increase in net revenues hitting a cool $1.08 billion. That is a solid jump showing they definitely moving in the right direction. Now, the operating margin tells an even more interesting story. Their GAAP operating margin is up a hefty 320 basis points, reaching 5.3%. But hold on, the non-GAAP operating margin is even stronger, up 270 basis points to a much more impressive 14.2%. This tells us that after stripping away some of the one-time costs or special items, VIAVI, core business operations are actually performing quite well. It is like looking at a car engine. Raw power versus its overall performance with all the accessories attached. And the bottom line earnings per hair or EPs, GAAP EPs, saw a massive 225% increase to $0.15, which sounds great, but again, the non-AP EPs tells us more about the ongoing business. And it is up 42.4% to $0.47. This consistent improvement across their non-AAP figures is a really good sign. Management is focused on profitability that can be sustained. They also returned about $16.4 million to stockholders through share repurchases in fiscal year 2025. This shows they are balancing growth investments with returning value to shareholders, a strategy many investors appreciate. Their fiscal year 2025 return to growth performance was fueled by expanding into data centers and aerospace. Traditional businesses are showing early signs of recovery too, which is great news. Wireless and cable products are still a bit pressured, likely due to big network upgrades not happening as fast as some might hope. But their aerospace and defense business is solid, and their anti-counterfeiting efforts are back on track, all contributing to this revenue growth. Now, who is driving this growth? Let's look at executive compensation. VIAVI claims to have a strong alignment between pay and performance, and they list a lot of good practices. They do things like having independent directors on their compensation committee, using independent consultants, balancing short and long-term incentives, and requiring at least a year of vesting for stock awards. They also famously do not do things like offer multi-year salary guarantees, reprice underwater stock options without shareholder approval, or allow hedging or pledging of company stock. These are all excellent practices that truly align executive interests with shareholders and prevent excessive risk-taking. It is nice to see a company actively avoiding common executive compensation pitfalls. The emphasis here is on pay for performance. They want to reward executives for achieving business objectives and driving VIAVI's growth strategy. They also aim to be competitive in attracting and retaining top talent, which is crucial in the tech industry. Interestingly, last year, SA on pay vote was overwhelmingly in favor, with 94% of votes cast supporting their executive compensation program. That kind of support is a strong signal that shareholders generally approve of how VIAVI is compensating its top brass. Looking at the CEO's compensation for fiscal year 2025, a massive 63% of it is performance based and 92% is at risk. This means a huge chunk of his pay is tied to how well the company does, either through bonuses or stock performance. That is exactly what you want to see. The numbers for the CEO's incentive payouts show mixed results, which is typical in performance-based plans. For example, they had a 40.3 percentile TSR ranking for one set of stock units, and a 29.6 percentile for another. This means they were performing better than a portion of their peers, but not in the top tier consistently. It is this kind of detail that shows the performance-based nature of their pay structure. The report highlights that the CEO's realizable pay in fiscal year 2025 was around 100.3% of target. This is a crucial metric. It shows that the value he actually could have walked away with, based on stock performance and achieved goals, was very close to what was initially targeted. When the numbers align this closely, it generally means the compensation structure is working as intended. Their compensation philosophy centers on pay for performance, competitiveness, and stockholder alignment. These are the pillars of good executive compensation. They want to motivate their leaders to exceed targets, balance short and long-term results, and ensure internal pay equity. Again, they emphasize their commitment to best practices like having fully independent compensation committees and avoiding things like golden parachutes or excessive severance. This focus on governance builds trust. A significant majority of the target compensation for their executives is performance-based. This is huge. It means that a large part of their pay is directly linked to the success of the company, not just a fixed salary. Their CEO's target compensation shows a good mix, with a substantial portion in stock awards. Let's break down those elements. Base salary is there to recognize the day-to-day job, but it is not the main driver of wealth for these executives. Annual cash incentives reward short-term financial goals. Then you have the long-term stuff. Market-based stock units or MSUs, which are performance-driven and tied to their stock price against a benchmark, and restricted stock units or RS which vest over time and are tied to absolute stock price growth, benefiting all shareholders. The MSU awards are particularly interesting. They rebased on the company's total shareholder return, or TSR, compared to other companies in the Nasdaq Telecommunications Index. This is a smart way to ensure executives are focused on beating the market and creating value relative to their peers. If they hit the 55th percentile in TSR, they get 100% of their target, and there is a nice upside if they outperform even further. The equity awards granted in fiscal year 2025 show a shift, with their CEO S-mix moving to 60% MSUs and 40% RSUs. This move increases the emphasis on long-term performance and potential shareholder value growth, showing they are listening to shareholder interests and adapting their strategy. Now, what happens if someone leaves under certain circumstances? They break down potential payments for termination or change in control. These plans are designed with double trigger provisions, which means accelerated vesting of stock options, and other benefits only happen if there is a change in control and the executive is terminated without cause or resigns for good reason. This is a standard practice to protect both the company and the executive in unusual situations. And the big reveal, the CEO pay ratio for fiscal year 2025 VIAVI, as CEO Oleg Kaikin earned about $10.6 million, while the median employee earned about $100,318. This works out to a ratio of 106 to 1. While this number might seem high, it is actually on the lower end compared to many tech companies, and it is calculated using specific CACE rules, so direct comparisons can be tricky. This section is crucial for understanding how compensation actually paid aligns with the company's financial performance over time. They show data for total shareholder return, net income, and non-GAAP operating income. Looking at the chart when their TSR was higher in 2021 and 2025, the compensation actually paid to their CEO was also significantly higher. This shows a strong correlation between their stock performance and what the CEO actually received. When you compare compensation actually paid to their non-GAAP operating income, you see a similar trend. Higher operating income generally aligns with higher compensation actually paid, especially for fiscal year 2025. This suggests their pay structure is indeed responding to business performance. Let's check who owns the company. BlackRock and the Vanguard Group are significant shareholders, holding over 15% and 14% respectively. It is also good to see that key execs and directors hold substantial shares, aligning them with all of us. Oleg Kaikin, the CEO, owns over 2.3 million shares, which shows a strong personal stake in the company's success. A key proposal is the amendment to their certificate of incorporation to include an officer exculpation provision. Similar to how directors are protected from personal liability for certain breaches of duty, this extends that protection to certain officers for duty of care violations. This is becoming more common as companies try to attract and retain top executive talent by offering legal protections similar to those afforded to directors. It won't shield them from bad faith, intentional misconduct, or breaches of loyalty, but adds a layer of protection for good faith errors. This change is about fostering a stable leadership environment by reducing the personal legal risk for day-to-day operational decisions, which is essential for retaining high-caliber executives. So, what is the big picture here? VIAVI Solutions Incorporated is showing strong signs of recovery and strategic growth, particularly in emerging tech sectors like data centers and aerospace. Their commitment to strong corporate governance and aligning executive compensation with shareholder interests is evident in their practices and in the positive say on pay vote. The financial health indicated by their non-GAAP metrics is encouraging, suggesting operational efficiency is improving. While the CEO pay ratio is on the higher side, the strong correlation between actual pay received and company performance, especially when compared to peer group TSR and operating income, indicates their pay for performance philosophy is being put into practice. The move to include officer exculpation in their charter, while standard practice, underscores their focus on attracting and retaining top leadership by mitigating personal liability risks for ordinary business decisions. It is a smart play to ensure they can bring in the best talent. Overall, VIAVI looks like a company that is successfully navigating a challenging market, diversifying effectively, and demonstrating a responsible approach to both business operations and executive compensation. What are your thoughts on VIAVI's performance and their executive compensation strategy? Do you think the officer exculpation is a good move for the company? Let us know in the comments below. If you found this analysis valuable, please give this video a thumbs up, that really helps the channel. And for more deep dives into the world of corporate finance and strategy, make sure you subscribe and hit that notification bell. Don't forget to join our Discord community for more discussions and insights. Thanks for watching, and we'll see you in the next one.